The ATM Bell Curve effect on pricing. You've heard me discuss the ATM Bell Curve a lot when talking about the married put position, how we use that to help our adjustments and to help the positions, and the structure of the trade. We want to be selling at the money, but we want to be buying essentially out of the money or in the money to be paying into the lowest time premium. And that affects spreads as well. In the discussion from last Friday, we talked about theta, and we talked about which theta has the highest decay. Well, of course, we expect the decay to happen in a certain range. The time value decay curve, the theta decay curve that you see, works on a huge assumption, doesn't it? The assumption is there's no change in the underlying stock price and there's no change in implied volatility. Very rarely do you have a market that does that, even for a 4, 5, or 6 day trade, at least not in the last 7 to 8 months or so. We know this is very rarely the case. We know that the highest monetary theta occurs right at the money, the at the money bell curve. Any expiration, whether you're looking at next week's expiration, whether you're looking at standard March expiration, whether you're looking out to December, the option that is closest to the current underlying stock price will have the highest time value, therefore have the highest monetary theta. In the presentation we had for Fernando, we saw that the theta actual pricing, the percentage decay, is a little bit higher if you're looking at out of the money options with a lower delta, because you might only be decaying 20 cents, but the premium was only $1, right? So you're getting about a 20% decrease, where the at the money is higher. You might be losing 35 or 40 cents on a daily theta, but you paid $5 into it, so it's much lower. Okay, so that we know that that's going to have the highest time value, the at the money option or the extrinsic value. Options pricing components made up of two things: intrinsic value, the amount that your option is in the money, of course, and the extrinsic value, sometimes called the time value, but that's not entirely 100% accurate. So let's take a look here. If SPX is trading at 44.75, the February 25th 4,450 call here is priced at 64.45. Well, it's $25 of intrinsic value, the 44.75 minus the 44.50 strike price. So the remaining value is the time value. The put, this is in the money call, of course. The 4,450 call is in the money from 4475. The February 25th 450 put is priced at 4505, has zero intrinsic value, all time value. So the time value or extrinsic value, the amount of the 64.45 option price is not intrinsic, is 39.45 for our 44.50 call that's in the money, and the extrinsic value 45.05 for the put is all time value. The price is the time value because there is no intrinsic value as well. All right, so this is where we're kind of looking at here. Those are the two components, but there's more to it than that. Again, they're not exactly the same thing. Extrinsic value is the value of the option that is not intrinsic price. Extrinsic value is comprised of the time value and the implied volatility of the option, which fluctuates as the stock moves, or in a nervous market or a hesitant market. Time value is not really extrinsic value. Time value is more of a component of the extrinsic value. And there's another factor that goes into play as this as well. What does all this have to do with what we talked about, the ATM bell curve and options pricing? So that time or extrinsic value swells as the stock moves away from the option price, back to the option strike price. It's increasing and decreasing. You can actually see extrinsic value increase without a change in implied volatility as you get closer to expiration, because the option is going from out of the money to now at the money, and then back to in the money. And this applies to all strategies, not just the married puts, where we use it to decide adjusting the married put position, when to sell the premiums with the 12 different income methods as well. It applies to all strategies far and near expirations as well. The moneyness of the option is part of that extrinsic value that remains in your position. Lisa's dilemma was she had sold a bull put spread, SPX 4570, and I think the 4415 position. I can't remember. We just need to focus on the 4570. and it was for the February 11th expiration. On Wednesday, February 9th at 10 a.m., SPX jumped up and was trading at 46.07. She's $37 out of the money, but the cost for closing the option was $30.70. Can you explain why the cost is so high to close this out of the money spread with just 3 days left? $31 per contract is expensive, but we're talking about SPX here. SPX trading at 46.07. That 30.70 to close is around 0.6 to 0.7% for 2 to 3 days remaining to expiration. That is actually within range of what we would expect for the time value on SPX, especially when volatility is increasing, and especially in the kind of markets that we're in as well. As I was putting together this presentation on February 14th, happy Valentine's Day on Monday, we're looking at the standard the weekly expiration, 2 days to go, February 16th. SPX is at 44.01. So that 43.70, 30 points out of the money, is very similar to her 45.70 price being 37 points out of the money. And what is the time value? What is the midpoint? 24.05, 0.6%, 2 days to expiration. That's what I say, that it is within range of what we'd expect. Yes, we're in a higher volatile market a little bit, but going back in time, going back to January, 2 to 3 days to expiration, 5 strikes, 6 strikes out of the money, 30 points down, 25 points down, 0.5, 0.6, 0.7% time value still remaining is not out of bounds at all. It's a reasonable range to see. So yes, it was expensive contract-wise, but I think it was still in the norms from what I've seen looking at other expirations as well. But let's take a deeper look at that 4,570 put strike we were talking about here. On February 7th, she was already in the position, but SPX closed at 44.83. The 44.70 had a midpoint price of 89.65, but most of that was intrinsic, isn't it? This had gotten away from the 45.70 put is up here on the in the money side for the puts of the at the money bell curve, and SPX is at 44.83. The time value was only 265 or 0.005%. 4 days remaining to expiration. And as we lead up to the scenario that Lisa was having a dilemma about, we go to February 8th. 1 day later, SPX closes at 45.21. We're going this way. The stock is moving up. It's getting closer to the 45.70 strike put option. It's only about 50 points out of the money. Okay, 49 points out of the money. The price of the option is 60.35 now. It did drop from 89.65 to 60.35. But the intrinsic value is $49. The time value, extrinsic value, as we get closer to at the money, has ballooned up to 11.35 from 2.65, even though a day has passed. Components of this 11.35 are the time value. Implied volatility changed a little bit. It went from 0.15, 0.148, I believe it was, to 0.181, something along those lines. So it's an increase, but we're also getting closer to at the money. This is why we're seeing this extrinsic value increase, even though time has passed, because of those two factors. We're 1 day closer to expiration, but the time value increased by $8.70. Okay, so clear that out there. Good. Next day, on February 9th, the dilemma day, of course. What happens now? Well, I didn't have the intraday prices. We saw at 46.07. She had mentioned that the price to close the spread was around $30. The stock closed at 45.87. 45.70 put is now the closest to the money it's been in the past 3 days. And the midpoint is 20.95. That's all extrinsic value. There is no intrinsic anymore. Our put is 17 points out of the money in this case, but we're closer up on that ATM Bell Curve. So the extrinsic value, whatever time is remaining, 2 days left to expiration in this case, now 2 full days. Implied volatility eased off a little bit. I think it was around the 0.17 range. 0.176 if I remember correctly. So it's changing, but it's not changing wildly yet. But again, we're the closest to the at-the-money bell curve that we've been. But 2 days to go. 17 points out of the money, just like our previous example, 0.5% time premium. This was at the close of the day. No, it wasn't in the first thing in the morning when she looked at it. So the incorrect thing to say in this case is time value increased from 265 to 1135 to 2095 as we got closer to expiration. How can that happen? And that's the incorrect thing to say. That's not the correct statement at all. The correct thing is extrinsic value increased from 265 to 1135 to 2095 as we got closer to at the money and closer to expiration. The highest time value, the highest extrinsic value, not the highest value. The highest value was 2 days ago when the stock was 87 points in the money. It was priced at 89.65. But again, that's why these positions can look so expensive. A 0.5, 0.6% time value, 2 to 3 days remaining, when you're really on the upper edge or around this peak of the ATM bell curve is not unheard of. This is part of the allure, I should say, for those investors that are trading 1 and 2 day out spreads on SPX and SPY with the Monday, Wednesday, and Friday expirations, because they can still see around a 0.4, 0.5% time value, but they got to be closer to at the money, taking that extra risk for those 1 to 2 day trades as well. Okay. Now, I might amend, of course, the previous slide there. Oh, let me clear that out there. Great. So when I said that extrinsic value is time value plus implied volatility, extrinsic value really comes down to time value, implied volatility, and moneyness, as in where is the stock in relation to the at-the-money bell curve. Now, what's not finished with this presentation, of course, is Lisa had a follow-up question. I answered her that essentially via email. But Lisa had a follow-up saying, I'd like to have a more detailed info as a guide like the chart you showed for the time value decay curve. And I'm going to go through that, but I haven't finished it yet. We're going to show various strikes in the money, at the money, and out of the money. 5 days to expiration, 4 days to expiration, 3 days to expiration, 2 days to expiration, 1 day, so you can get a view of that based on theoretical pricing, not the actual pricing. We might use some actual price in that discussion as well. But based on our previous slide there, what else do I have to show? Well, I have to show one example of those charts with, what is at the money, then maybe, let's say, 10 points in, 10 points out, 20 points in, 20 points out. How much time remains? 5, 4, 3, 2, 1 days to expiration. At, say, 0.15 volatility. What are those same charts at 0.25 implied volatility, 0.35 implied volatility, and maybe 0.45? See, that's going to change drastically because the expected time value percentage is going to increase a certain percentage with each little movement or each movement of volatility. Even a 0.05 movement, say go from 15 to 20 to 25, you'd see a significant change in those expectations of extrinsic value. And so, leading up to it again, just to verify what we talked about let's see, okay, 5 days to expiration on 222. This was yesterday afternoon. Yesterday afternoon, SPX was at 43.80. 5 days to expiration for the 222 series, and the 15-point out of the money 4365 put with a volatility of 0.2333. What I added here, this is our Black-Scholes calculator. The prices look the same, don't they? 15 points out of the money relative to where Lisa's 4,570 put was at the close of day on February 9th, even though she saw it at 46.07 at the open, which is about 30 points out of the money. But 15 points out of the money, 5 days to go to expiration, expected put bid of $40. It's all time value, but that's 0.91% extrinsic. 35.25, 2 days into the trade, essentially with 4 days remaining to expiration, 0.80. 3 days in, 3 days to go, 29.65, right around that $30 that Lisa saw to close the position, 0.67 extrinsic. 2 days remaining to expiration, So on 220, with 2 days remaining to expiration, 2303, right around the wheelhouse of what we saw, 2095 at the close, and it had a lower volatility of 0.18. That's why it was only at 2095 instead of 2303, and that's 0.53 extrinsic. I highlighted this because it's very similar to what we saw with that other 2-day out option on February 9th, when the stock closed at 45.87, what it was, and we were holding the 45.70 put that was right at the money. That was 2095. This is 2303.53 intrinsic. We're in the range that we'd expect to see with the price of this stock and the securities involved. 1 day remaining to expiration, 1450.33% extrinsic value still holding in that case. And then at the end there, it would expire worthless. So that's just to help Lisa a little bit there, that what she was experiencing, why it was so high to buy it back. When you went through those different cycles, it contributes to 3 things. There was some shift in implied volatility. Yeah, that's the one I wanted. But there's also the moneyness factor involved, where as you get closer to the money, even with 1 or 2 days left to expiration, we saw the extrinsic value increase from 265 to 1135 to 2095 as we got closer and closer to the at-the-money bell curve, even with only 3 days and 2 days left to expiration in that case. And that's sort of the effect there. Remember, the extrinsic value, time value is more of a component of extrinsic value, which also takes into account implied volatility and the moneyness that we just sort of showed a little bit.